You're connected to computer audio.
So Trish got outed, by the way.
Wait, hold on. Why does it look like this right now with that in the middle?
What?
Why does it look like that with that in the middle?
What is that? I don't know.
It's the video.
That's the old video. Yeah, don't use this one.
Well, that's the only one. I mean, that's the newest one.
Yeah, can't use that one.
Structure. Hello, everybody. Thank you for joining us today on today's webinar on succession planning for financial advisors. Just waiting for a few more folks to stroll in here. We have a pretty good turnout today, so I want to make sure everybody's participating. Please feel free to ask any questions on the chat feature. We're going to try to get to everybody, but there is a lot of people on this, probably one of the most that we've ever done. So looks like it's certainly a hot topic. My name is Joe Nupieri, co-founder of Compass Acquisitions, and I'm here with my partner Scott Brittman.
Hello, everyone. And yeah, if you have any questions, feel free to raise your hand. I could allow you to talk. Or if you want to type out questions, you're more than welcome to do that as well too. But we will try to get to everybody. So we got one already, recording available later. Yeah, well, actually, we've been uploading them onto our YouTube channel. So I'll send everybody, or Joe. It'll probably come from Joe. We'll send you out a link to the recording as well. It will probably be tomorrow that we have that uploaded, just because it takes some time to get up there. And then we'll also be sending out a copy of a practice profile to send out. And we're actually offering right now a free valuation for anybody that attended the webinar. So if you fill out the practice profile, send it back over to us. We'll actually do an actual valuation for your practice.
Okay, everybody. I think we're just waiting on a few people, and then we are going to get started here. So appreciate you hopping on today. And I know it's a holiday, so I do apologize. I know a few people couldn't make it, but just really let's see here. What do we got? I just want to make sure everybody could hear me. If not, please say anything on the chat. Just want to make sure sound is working, and then we should be ready to go. If you have any questions, we like to keep this as interactive as possible. So feel free to raise your hand or ask any questions throughout the presentation. We'll try to be mindful here and keep everybody really to about want to keep it to maybe 45 minutes. So we'll pretty much get started right into some of the material. My name is Joe Nupieri. I'm one of the founders here of Compass, and I'm joined with one of my partners, Scott Brittman. And we're just going to kind of cover a little bit about succession planning, talk through some different, we'll go, let me just go to the next slide here. Okay. So, this is this is the guideline here of what we're going to cover today. So we'll try to go into a little bit of detail on each one. Really, just starting with the importance of succession planning for financial advisors and insurance agents as well. But mainly, the advisory space is what we're specializing in. We ensure to ensure continuity and protect the client's interests. Finding the right successor. I think that's certainly important to cover and understand as you're going through the process. Going through typical deal structures, certain items to consider, finding the best deal structure possible. So I think everybody's gonna deal structures. There's a million of them. I think everybody's gonna structure it based on what their goals are, how long, timeline, things of that nature, which we'll cover as well. Valuations, always a popular topic to cover. I know there's a lot of numbers, a lot of multiples that people throw out there, so it just depends on your book, how it's made up, and some different quality items too that we'll cover. Some legal and compliance considerations. I'm not an attorney myself, neither is Scott, but we some things that to consider there, and then just timeline options for the succession plan. I know a lot of people are, I'm 1 year out or I'm 5 years out. So just kind of cover what those timelines look like for different circumstances. So with that being said, I'll turn this over here to my partner, Scott. Okay.
All right, so evaluating succession options, identify a potential internal successor within the firm is your first option, and usually a pretty good one. I think that if you could find somebody within your own firm that has been working with the clients, obviously, there's going to be a lot less of a turnover there, or um, really problems with the retention with the clients if you have somebody within the firm. Exploring an external option like a merger or sell and stay, or really a full or partial acquisition, is always a good option as well too. Really, if you are going to look at external options, I think you want to make sure that the buyer has a really good transition process in place. Preferably somebody that has done this before that can kind of show you their proven track record at, really bringing and transitioning a book over and repapering the clients. And, so a lot of these teams that have done this before really have a good process in place. And I think that's kind of an important characteristic of a buyer when you are looking at an external, acquisition. You could also consider grooming and mentoring a new talent, a junior advisor, bringing somebody in. Sometimes can be a little difficult. I will say that. If it's somebody that you're just bringing in that you don't really know, do you want to put the time and energy into potentially training somebody? And the dropout rate amongst young advisors these days about 90%. So just be careful with something like that. If it's a family member or something that you're trying to potentially groom to take over the book, that seems to work out a little better. But the new advisor coming in, just make sure that you're putting your efforts in, to train them and just make sure that they're, going to stay on and eventually take over the book, or really you'll be restarting that process from the beginning if they do end up leaving. And assess the financial and operational feasibility of each option. I think if, for instance, you're with an LPL, they're the biggest independent BD out there. You should have no problem keeping that internally within an LPL. We work with several LPL advisors right now, and the LPL to LPL thing kind of works itself out pretty well. If you're with different BDs, you could also look within that. Your broker dealer may actually have um, really some resources to help you find somebody internally. It's also something that we do on our end as well.
Yeah, I think a lot of people that we talk to, I think one of the main reasons that or deal breakers, which we're going to cover here, is usually I don't want to repaper, and I think that's be more and more. I think with the consolidation of broker dealers like Osaic, with all of the companies that they combined, and also LPL acquiring a lot of different companies. There's a lot more people under the same broker dealer. So folks who had to repaper over the last 3 to 5 years, if you have a 3 to 5 year timeline, chances are you're not going to want to go through that process again. I will say there are certain firms that make it as easy as possible, but there's still more work involved. There's no question about it. I think even certain internal broker dealers, you have to repaper. I know certain Cetera broker dealer, you have to repaper from one over to the next. I don't believe that's the case with Osaic. Same with even LPL on most of their acquisitions. Commonwealth being the latest, although we're being told Commonwealth advisors may not have to repaper, but I think ultimately they will, and that's just the nature of it. So it's just finding the right fit there, and seeing what must haves you have here. So that we'll cover that right now, which go right into that. So finding the right successor. We'll start right there. What are your must haves? We talk to a lot of advisors where the first thing we might say to them is, hey, we might have an opportunity in the area, but if you're looking for a successor or somebody to purchase the book or somebody to merge with, what does that look like for you? What are the must-haves? Is it they have to be with the same broker dealer? Is it they have to have a certain client service model that they follow? Do they have to be in a certain location? Is that important? Physical offices. I know with after COVID, obviously, a lot of advisors are switching more to a virtual model. So location is not as important as maybe when I started doing this, maybe about 13, 14 years ago. But I think it's still important. There are still people who have local offices. They see their clients, and certainly wouldn't want to disrupt their clients, make them have to drive further. Or now a client who was used to staying in and going meeting you at the office now has to do something else. That you want to try to avoid that when you're transitioning out. So, and I think most savvy buyers, we'll call them, or advisors who are still in growth mode, know that. So it's just a matter of figuring out what those must-haves are. Conversely, the deal breakers. What are the deal breakers? What do you absolutely not? I mean, we talk to people who are, they do a lot of dimensional funds, right? And they want somebody else who does dimensional funds, and if they're not interested in talking to them. I've had RIA advisors who don't have any broker dealer affiliation tell us that if they are affiliated with a BD, I'm not interested in having a conversation with them. So, some people are a little over the top with maybe their deal breakers, but I think at least as a starting point, it's good to know what you absolutely would not want to see in a successor. And once you kind of map out the must-haves with the deal breakers, I think you could sort of narrow down. I know there's some other companies like listing services and things like that, where if you're a seller, you post your business on there and you have like 500 people reaching out to you. That's not what our company does, but nonetheless, I think it kind of overwhelms you, but it allows you. I mean, trying to narrow down 500 down to 3 to 5 can be challenging. So I think just having those is important. Personality is always going to be the one of the top things. You have to like them, they have to like you. I think if you like them, chances are your clients will like them as well. So I think that's certainly important. And going back to the investment portfolio, does that match? Do you use third party money managers, or are you actively trading on all your investments? Do you use a lot of ETFs? Sometimes you're not going to get somebody, because every practice is different. It might be hard to find that perfect fit depending on what you're looking for. But I think these are things where you want ultimately, for it to at least align with a potential buyer or somebody who's going to take over your clients. Because, the reality is you probably have relationships with these clients for 20, 30 years. So I think that's important. The portability of the clients certainly is something you want to find out. If all your clients can't come over, or if it's a certain product or proprietary products. I know certain companies have, whether it's River Source, but now I think some of the other independent broker dealers are allowing a lot of those. So portability of clients is something you want to look at, and then just really pros and cons of each buyer. I said it earlier. I think we always recommend talking to at least maybe two or three, if not, 3 to 5 at most. I think more than that becomes overwhelming, but just weighing the pros and cons of each, I think will help you ultimately come to the determination, and then you'll figure out price. Nobody price is never important until it is, which is always the case here, but price is normally like a 1A versus the personality and the fit being the one. So important topic, but certainly something to think about.
And then structuring the sale, I think it's important to kind of figure out what direction you want to go in when structuring the sale. If you want upfront money, well, 100% upfront money, you're going to find yourselves given a little bit of a discount, I would say, or a pretty significant discount, honestly, just because of the retention clauses involved in that and upfront money. But typical deals that we're seeing range anywhere from 10 to 50% down, with the remainder either being financed by yourself, the seller, with a 3 to 4, usually 3 to 4 year note, with about anywhere from 5 to 10% interest. The other way that a lot of people have been doing these deals recently has been bank financing, and there's a lot more banks that are financing these deals now. They're very favorable terms for the buyer. It allows them to really spread out their cash flow. on the practice so they can make money as they're still paying it off. And the nice part for the seller is you don't have to deal with anybody. You get your money. Typically, they'll hold it a 12-month period where basically if you hit all the retention numbers in your book of business, typically 85, 90%, you'll be paid out the full amount within 12 months and you don't have to deal with anybody making payments or potentially defaulting on payments to you in that time frame. And a lot of buyers are using that option now, so it's become very prevalent. And then there's also an earnout, a percentage of revenue. You can do an earnout anywhere from 2 to 5 years, where basically you're getting a down payment on the book. Maybe you're helping convert that book over from something like UITs to manage money, and you share in the upside of the book. So a typical earnout will look similar to basically you, the seller, getting a little bit more of a percentage at the start of it, and then it kind of weaning itself off towards the end tail of that until you're, basically out of the business and the book is bought by the actual buyer.
Yeah, and I think a sell and stay too is in something that we're hearing a term we're hearing a lot now. Everybody, you want to. Everybody says they're 5 years out. Yeah, not everybody, but I think ultimately you're like, I'm 5 years out, but that date doesn't have to necessarily be a solid end date. So I think structuring a deal, the good thing about structuring a deal over a 3 to 5 year period, let's say, versus saying, hey, I'm going to stay on, just do that myself, and then in 5 years I'll look to pull the trigger on something. I think why more and more people are doing it that way is because it gives them the comfort knowing that, hey, I have the succession piece in place. My clients are starting to slowly get used to the office, get used to the new advisor. It ends up being a slow transition. So in doing that, it benefits you. Plus, if God forbid something happens, right? We all like to talk about getting hit by the bus, so to speak. If something does happen, then obviously the value of your practice is strong versus even just a normal. I mean, buy sell arrangements are great. I think a lot of firms require you to have one. But at the end of the day, if that person doesn't know all the clients, doesn't have a good relationship with them, if something does happen, it ends up being, I mean, you could come to an agreement, I guess, on a sale price on the buy sell, but a lot of times it's challenging for the buyer to try to transition everybody over. So it's just a few things to think about. I will. Does anybody have any questions so far? I don't want to go too fast through this, but I know we covered a few items here. It looks like let's see, somebody's got okay, repapering. So there is a question. Sorry, it took. I wanted to cover that, but yes, define repapering is one of the questions asked here. So yeah, repapering is really just going like if you're with LPL and you want to sell your business to an advisor who is with Osaic, you have to go through what's called the repapering process. So, it's more work than if you don't have to do that. It's really you just change a rep code in many cases over to the other advisor. When you repaper, now you have to have all of your clients re-sign all new paperwork. And you have to explain to them, hey, here's what we're doing, here's the move we're making. Usually explain it to them anyway, but repapering just adds that extra step of having to go and now get everything. So it's a little more work, but that's essentially what repapering is. And certainly we can go into what that is more, what that looks like, but that's why there's a little added step there. Another question here from do you want to add something on that, or just okay, another question from Marianne. Thanks, Marianne. Wouldn't sell and stay described also be best for buyer for retention reasons? Yeah, I mean, absolutely. I think it's a lot of buyers want somebody to stick around for a while. There's no question. I would say a majority of them do. You know, I've seen sales happen where it's, they want out in 12 months or 18 months, and, they still have a very high retention rate. I think, most of the savvy or really good advisors could, I think they know how to do that. They know how to, like, they can word a letter out to all the clients. They meet with them. They do a meet and greet with their clients and their client. Like, they're really good at being able to bring the new clients in and make them feel comfortable. So you could do it both ways, but yeah, I think a sell and stay for sure is. I mean, I know I have advisors we work with who prefer that. So again, it's going to be a different advisor. It's, everyone is looking for different. Some people don't want people staying on for 5 years. I don't know why they wouldn't, but some people just want to buy it. And you still have to stick around for. That's what I tell people too when it comes to timeline. If you said, hey, I want to be out in 2 years, right? Well, look at the timeline on that. So you have to go and start finding that person, right? Once you find that person, then you have to you structure a deal, go through that process, which takes time. It's those don't that doesn't happen overnight. And then, from there, you have to basically, I don't know. It's hard to, like, from there. I forgot what I was going to say. I had something in mind that I was going to say. I was answering to somebody's question, and then I'm sorry, I got sidetracked because somebody else answered a question, asked a question here as well. Scott, you want to take that one?
Yeah, it says, how do you avoid selling away for the book to an outside advisor? Um, I mean, I think that you want to define somebody internally first, if possible, within your broker dealer. That's something, we do that's a service that we provide. We can help set you up with that. That's also a potential service that your broker dealer may provide to you as well too. There are several broker dealers that will introduce you to potential successors within your BD. But that's kind of how you would do that. And then how is growth of practice accounted for in sales stay?
Yeah, I mean, the sell stay, you could do a few things. You could do it as a percentage of revenue, right? Which I think, that a lot of times accounts for the growth in revenue. You could say something like, hey, we're going to do a 50-50 revenue split over 5 years, right? That means you're participating essentially in the upside to that. And then usually what'll happen is at the end, the valuation. So if you've grown that book from 300,000 in production, and 5 years later it's at 450, the value of that book is going to be worth more too. So, it depends on how the payouts are structured. It could, if it's off a revenue number, it might already be calculated in the valuation additionally. Or if you could do a sell and stay where, you do something like, hey, we're going to pay you out. You're going to take a salary now, and any new business you bring in or new production, or if bring brokerage accounts over to fee based, we're going to give you a 2.5 or a 3x multiple on everything you bring over. So there's a lot of different ways to do it. It's just finding out what's going to work for the buyer and the seller as well. So
And then another question in a sell and stay, is it possible to structure the sale in trenches? Yeah, absolutely. We see a lot of people buy into the book. So you may initially, let's say if you want to stay on for 5 years, you can initially sell off maybe your B and C clients first and really keep your close clients with you for the, first several years, and then sell the remainder of the book. You could do it in trenches of 25% of the time over 4 years, 20% over 5 years. There's really no, you could do it any way that you want. And usually when you find a good buyer, somebody that's done this before, they're pretty flexible in terms of how they want the structure of the deal to be laid out. And I think it's very important that you kind of make it known what you want to do. If you have an idea in your head, hey, I want to sell off the book in trenches of over 4 years, 25% of the time. It's a really good way to wind down and really start offloading some of maybe the more irritating or menial tasks that you no longer want to do. Maybe getting rid of compliance stuff is the first thing you want to get rid of, and then giving up some clients, and then eventually down to the fact where you're sunset off and retired.
Yeah, and at that point, you most likely want to be a part of their firm, or at least with the same broker dealer, right? Because I don't think broker dealers are going to let you just sell chunks of your book out to another broker dealer, which that might have been what Eric was referring to at some, on the selling away comment as well. So we'll go back into that. But I know, and I appreciate everybody asking questions. It makes for new material every time we do one of these, so I appreciate it. But I want to make sure. It looks like the questions have stopped for the minute, so we will. Let me just keep moving on here. I don't want to take up too much of everybody's time. So let's go right there. So that brings us into business valuation. Um, Business valuation, there could be a lot that goes into it, but it really breaks down into a simple, yeah, multiple of revenue and on some of the regular smaller books, right? I think the larger practices, you want to account for EBITDA, look for at cash flow a little bit if it's a full business. If it's just a book, you typically you don't need to see tax returns or anything if it's just the book itself. If you're buying a whole business, a lot of employees, maybe an office space or what have you, that you want to look more at the whole EBITDA of the firm and see what exactly you're buying. But I think some of the things you want to start to prepare for business valuation, I would say having your necessary paperwork. I think P&Ls are always a good thing to have. Tax returns, again, like I said, it's not needed on every deal. I think if you're doing bank financing, they want to see the tax returns of the seller. So they would want to see your tax returns if the buyer is going through a bank in many cases. But if it's being financed internally through your broker dealer, and it's just a 40-50 million dollar practice, then it's just the book of business itself. No tax returns are required, but revenue breakdowns, commission statements, anything like that you can get from your software systems, I think are that's good to have. I think you start being prepared, right? Because we do a practice profile. So everybody who attended, or if whether you had the chance to sit in here today or didn't, we're going to provide everybody with a practice profile. We'll send a replay copy of the presentation as well, but we'll send out a practice profile. A lot of people like to fill out their info, and we could kind of give you a valuation report, and just kind of give you a sense of maybe what your business is worth. Now there's five or six, maybe more, other companies in our space that do valuations. Ours aren't certified or anything like that, but I think we have a pretty good understanding of, based on the information from that profile. So we'll do that, and there's no cost to that. So if you're interested in just finding out more about valuation, we could certainly help you with that. I think having it valued and determining the fair price is really that gives you at least a starting point. I've heard a lot of advisors say money doesn't matter. I'm well off. I don't need it. And that's fair if that's the case. But I think you still want to know what a fair value is. I've had people who think their value is way more than it really is. And it becomes harder to potentially sell or find the right fit. You might have somebody who's a right fit, but he's like, I'm not paying 4x or 5x for this person's 20 or 30 million dollar book. So you got to figure that. The tax implications are, whether it's structured as capital gains versus ordinary income. I think that's the benefit to being on the independent space versus the wirehouse or on a W-2 model, is the sale of your business can be structured more towards capital gains. So on all of the deals that we do, because it's so state specific, we always recommend you have your own accountant just look over, different things, make sure they're, but the buyer, seller, us, we could certainly set that up so it's structured more as a capital gains. That's something you want to definitely consider. And then obviously the last one, just making sure you talk to your accountant, and make sure everything looks good on that from your end. And that puts you in at least a good place to get started. And it looks like there's a question.
Yeah, it says, what if I have a tax practice that is highly integrated with the advisory practice, all one entity currently? Any suggestions for selling? Yeah, so there are a lot of advisors that do both of that. And you could initially start off with trying to look for somebody who does both of them and is a good fit. If that doesn't work, you can sell off, both each individually as well, too. I think looking for somebody that does both of those things together would be your first, start. And then if you have to break it up, you break it up. But I think most buying advisors are going to be at least open to the concept of that and potentially bringing in, a CPA, or at least partnering with one that can help, ease that transition.
Yeah, I think, and that's that for somebody like you, that's going to be one of your maybe must-haves, right? Unless you really just want to, sell one and keep the other maybe for a little bit. But I think one of your must-haves in that scenario would be, yeah, I want somebody who at least is a CPA, or has an advisory practice, or is willing to, have somebody keep somebody on, and keep this thing running. And as long as it is, then it's value. I mean, I always tell, like, your business is worth what somebody's willing to pay for it. So I think if you're going to get top, the most value for it, you're going to want somebody who values, I think, both the advisory and the tax side of the business. So let's move on to this. And that's,
And
well,
these
yeah.
are items that affect valuations. Number one, recurring revenue versus transactional revenue. Obviously, recurring revenue is king. Really, managed money is king. I mean, we're seeing multiples on managed money right now, ranging anywhere from 2.75 to 3.25 times revenue on the managed money aspect. Still seeing two times revenue on trails, and then really anywhere from 0 to 1 times revenue on transactional products that you may have. And that's going to vary based upon, how long they're stuck in surrender for, if there's fees and whatnot. But obviously, recurring revenue is king, and that's what's going to get your book valued, the highest. Number two, client demographics, age, location, age of your clients. Typically, if you're seeing clients that are under the age of 70, you're going to see a little bit of a tick up in the multiples. Once it starts getting over that, you're going to see a little bit of a down tick in terms of the multiple. Location, not too much of a factor, honestly, when it comes to valuation. You may see just higher retention clauses, or maybe retention clauses based strictly on GDC when it comes into something like that. Number three, number of households. That's definitely going to play into multiples that you're seeing on your valuation. If it's a $30 million book with 1,000 clients versus a $30 million book with 30 clients, you're definitely going to see that the 30 million with the 30 clients be valued, I would say, a little bit more than just an uptick, a little more significant than it would for client age demographics. And then how transferable is your client base and their assets to a new firm? Do you have proprietary products that you have with Ameriprise that you're not going to be able to move over, and you may have clients that have mixed products, like one may move over and one may not. So I think it's very important to kind of make sure that if you with an Ameriprise, let's say, and you have proprietary products that are not transferable, like you may want to make sure that you're staying within Ameriprise, finding somebody within there, and if not, you may end up leaving some assets on the table on an external acquisition.
Yep. And Marianne, how do you define low assets? I mean, I think, you know, in relation to the number of households, I think it would be something like, you have 500 clients with 20 million in assets.
I
I
think it's more of a ratio thing as
Yeah,
opposed to low assets. I don't. There are no low assets. I
yeah.
could.
I
We could
mean,
find you a buyer if you have 5 million in assets. I think it's more of that ratio in terms of how many clients to how many you know assets under management is more of what that kind of thing.
yeah. I mean, if that same $20 million book has 30 clients or 20 clients, I think, that becomes a lot more valuable to somebody than a book with, that same 20 million with 500. So that's really, what we're referencing to on that one, in terms of low assets. So, okay, let's see here. Legal. I love this part. Yeah. So legal. I mean, I think this is really, we do the same thing. So like when we're putting a lot of our deals together, we help with the structure. We get to a certain point, right? We can help with purchase agreements. We can help with all that, but we're not attorneys or accountants. So what I always, and everything is state specific. So I think you want to have an attorney at least just look it over. Yeah, and whether it's us doing the purchase agreement or your broker dealer or whoever is going to end up working on the purchase agreements with you, I think it's always important to have an attorney look at it. Now, if it's an LPL to LPL deal and you have an LPL attorney look at it, I don't know. I mean, it depends on how comfortable you are with that person, but there may be maybe they're not acting in your best interest there. So I mean, it's not most attorneys when they get too involved, it becomes a problem because they start redlining, the other attorney redlines. Next thing you know, there's a whole purchase agreement of redlined, and everybody's mad at everybody, and the deal falls apart. Keeping it simple is important, but making sure you cover everything is also important. So, same with existing compliance policies, procedures, making sure they align with all the regulatory requirements during the sale process. A lot of times, whether if it's an RIA, your own compliance team will work on that. If it's a broker dealer, their transition or compliance teams usually have everything that they need to make sure that that's a smooth process. And then really just making sure all the contracts are address everything. Our purchase agreements or any purchase agreement should have a good non-compete in there. You don't want to sell your practice to somebody and then a year or 2 years later, well, actually, I should say the buyer doesn't want to buy a practice, and then a year or two later, the seller is now taking all those clients and starting their own book. Things like that, are more geared towards the buyer than you with a non-compete, but again, it depends. And then just any seeking counsel, just basic legal regulatory compliance issue. I mean, there's kind of a dry topic, not much to really cover on it. I think it's important to, make sure that you have all that put together. And we could certainly guide you, or any of the firms that you might be working with would certainly guide you, I would hope, in the right direction there.
And I would say this as well too. We have templated purchase agreements that we provide our buyers with. I would have them provide you before you even get your attorney involved. I would have them provide you with a purchase agreement, and then have your attorney start looking at it and redlining it first. Have them do that process so you're not wasting your money on it. We provide that to our buyers in our program, so we can put all of the information into the purchase agreement, get it ready to what the terms were that sort of agreed on at that point in a letter of intent, have them send it over to you, and then get the lawyers involved to kind of start redlining. So it will save you some time and some money doing something like that, as opposed to you going out there and getting a purchase agreement done for yourself. And then popping into succession timeline and implementation, establish a clear timeline for the succession plan. How long do you want to stay on for? I think it's a very important question to ask yourself. as you're going into the process. When do you see yourself walking out of the door? When do you want to be out the door? Is it 1, 2, 5 years? If it's 5 years or more, you're probably looking at a merger slash partnership, where you may have the basic structure down, or a back end deal where, God forbid, somebody passes away right in the middle of it. You at least have something set up for yourself where you're covered. Having a death and disability agreement set up for yourself, regardless of how many years you are out right now, is always a good idea. It's always going to save a big portion of the value of your book. So, establish a clear timeline for yourself as to when you want to be out of the business completely, and kind of make that clear, to the buyer, is always going to be helpful when structuring these things. Are you looking to continue to grow and structure an earnout? Always a good example of somebody who's kind of prime for an earnout is somebody who has products that are going to be easily convertible to that managed money model. If you have that, and UITs are a pretty good example of that. We're dealing with a book of UITs right now. That's why I'm kind of bringing it up. But they're pretty easy to convert over to the managed money platform. And if you stay on and kind of help in that process of converting those funds over to the managed money, you're going to share in the upside potential of your book when you're doing a sale. If you're completely managed money right now, an earnout probably doesn't make too much sense, honestly, because you're probably maxed out in terms of the revenue that you're getting on that book right now, especially if it's 1%. Obviously, there's going to be some hidden assets that a younger advisor goes in and is able to find. You could structure an earnout, but for me, the earnout process, is a lot easier for somebody who's trying to convert over the book to the managed money process and help, and also share in the potential upside and valuation on that. And
Yeah.
then maybe all you need is a contingency plan, and I think that's very important to have. God forbid something happens, you may not have a time frame in mind for yourself at all. You enjoy working, you really don't see a time frame at all right now, but just getting something in place, even if it's not with who you actually are going to sell your book to, having something in place will save at least 50% of the value of your book of business. We've seen people unfortunately pass away at their desks, and what happens is most of those funds end up going to the broker dealer, and they're distributed out through different clients. And I mean, really, it's not ideal for your client base. You may see them frustrated and potentially leave as well too. And
Yeah.
then ensuring a well-structured implementation process. And I think that kind of goes back to kind of who you're picking and how you're going to potentially move the book over, and so on and so forth. Outlining how many years you want to stay on, when you want to be out by, and kind of getting those meetings set up with you and the potential buying advisor.
Yeah. No, and one thing to just sort of touch on with the earnout thing, I think, and Scott kind of hit on it here, but I think it's really for somebody too. Like if you do have that all fee based book, the only way you would really want to do that is if you think you could you like actively going out and finding new clients, and if you think you could bring on another 20 or 30 million in the 5 years that you're that then maybe it could make sense because the practice will be worth more as you bring on more assets. But I think you have to really know most people who are 2 to 3 years out, they're 2 to 3 years out because they want to start taking a back seat. They don't want to now start to like really hit the ground, and unless they have a really good referral source and think that they could grow there. But yeah, the earnout is more for folks who are really, they want to stay on and they're still hungry to grow. And we have let me cover this question here because I know we're getting to about 45 minutes, so I want to make sure we could wrap this up. So let's see. How about 401k assets? My experience, this business is rarely valued, included in valuation. I see it as a potential source of ancillary business. So 401k assets, I mean, I think there is value to it. And this is one of those things where it's worth what a buyer is willing to pay. But at the same time, because some buyers may not know 401ks or know what to do with them. So they don't even want it. So they're valuing it at zero. But if I'm putting a valuation together on 401k assets, I look at it as, are they getting usually 25 basis points, right? So it's on the lower fee end, but there's still recurring revenue. So people who want 401k assets and are open to the purchase of them, I think I don't see any reason why a 401k book can't be valued at a 2x multiple, right? It's not going to be on the higher end of the recurring revenue like a managed account or advisory, but I absolutely think 401k assets have value if there's a recurring revenue. It just goes back to recur. It's the same thing as 12b1 fees. 12b1 fees are recurring. You would pay a 2 or even a 2.25 maybe multiple on something like that. So if it generates recurring revenue where the buyer buys it and they don't have to do anything, the revenue is just there once they bring the client over. That's valued at a 2x. It's usually more of the transactional, and upfront I took a 7% commission on an annuity, that kind of stuff usually is a 1x value if it shows a repeated history of being able to bring that in. But yeah, I think 401k does have a value for
Yeah,
sure.
and if you have a large 401k book, you're going to want to find somebody that's doing that. That's got to be a characteristic of the buyer that you're potentially looking for. Is somebody that has experience in 401ks, has some, wants them, will value them. And I think you'll be able to find that. I mean, they say there's 50 buyers to every one seller. You shouldn't have a problem finding, kind of what you're looking for. And again, that's something that we're able to help out with as well too.
Yep. So let's see. Shelley missed the indication evaluation of managed or advisory book of business with recurring business. Um, it can be. Can it be? She asked, can it be more than 3 or 4x of the annual revenue on advisory business? So yeah, I mean, I don't. We're not seeing. I mean, whether it's private equity or some of the broker dealers, right? Like if you're 100 million, usually or up, and the broker dealer wants to buy it from you, they tend to offer higher multiples. But then then you're just selling it to the broker dealer. Maybe you stay on as a consultant for a little while, but I guess they would in many cases pick the advisor that's taking over some of those clients. So it's I mean, it happens. You can definitely get it. Private equity, I'm sure, would do it. They want control. So it depends on how, but I think a normal, let's just say it's a typical advisor looking to grow, and let's say he's got 100 million, the buyer, and the seller has 40 or 50 million. I think 3x, if it's a really good book, I think 3x is fair. I don't know how much higher you're going to get than that, maybe a 3.25. But as you start getting larger, the multiples do increase. So that sometimes can happen, but then you become, now it's really multiples of EBITDA, right? So, we're seeing anywhere from 5 to as high as, I mean, I have billion-dollar firms telling me they've been offered 15x on EBITDA for their practice. So, there's a wide range there. And again, it'll depend on how it's structured too, right? If you want most of it up front, probably not getting a lot of, a higher multiple. If you want to do it over a couple of years through a revenue share or percentage, you can work and somehow you could structure it to look like, at the end of the time, you're getting a 4x multiple for that. So it's on how you structure it. And I think that really depends on how the multiple looks. But I think we're not seeing, I mean, we have people who, if it's a regular book, 30, 40, 50 million, I'm not, at least any of the buyers that, I've talked to, and we work with a lot of them, they might not be open to giving a 4x or a 4 or over 4x for something like that. Now, some people are. I mean, we work with a lot of them who would just be like, yeah, sure, 4x, I'll give you that if the book is right and I like everything. Again, it's just going to be the buyer. I think that really depends on it. Some buyers will see value in something more than another person. Somebody, and you don't normally pay for upside or potential on these books, but I think if you're an advisor and you see that there's a significant upside with this practice, that might get you to say, you know what, I'll overpay a little bit for it. It's not the end of the world. It's going to pay off for me. And, as long as the economics work for the buyer, that they'll, some of them will make it work, but that's going to depend. So, let's see if we have, and again, I appreciate all of the, I know we're getting to 51 here, so I don't want to, we're getting to the end, and I do appreciate the questions. Again, that really helps out. Just kind of keep the flow of the instead of having us sit up here and talk the whole time. So I do appreciate that. Let's see a little bit about us. We're a consulting firm. We specialize in business acquisition, succession planning, services for advisors, insurance folks as well throughout the country. We facilitate acquisitions and mergers, within this space specifically. I personally have been doing this about 13 or 14 years. Scott, not too much. He's about the same as me. And we're all about finding the right match. I think in the years of doing this, some of the deals we put together, if it's not the right match, we're wasting our time, you're wasting your time. So, having those introductions to make sure you like the person. Are they likable? I've had people get off an intro call with me, a seller or a buyer, and be like, I don't like that person. Who else do you have? So, I think that's part of it's like matchmaking. People kind of been told we're like the match.com in a sense of financial advisors. And it's more to do with that. It's not a transactional type of business. So we kind of help with that. And then, offer everything from, our active search program we have with buyers across the country who, are out there aggressively looking to, bring on new assets. And then we work with advisors who are on the succession planning side, doing these webinars and talking to them about the valuations of their businesses and, just kind of what their situation is. So anything from that, valuations, consulting, any of that. So that's in a nutshell, Compass Acquisitions. And yeah, I mean, that's other than that, we are going to be sending like I mentioned earlier, a profile to everybody. And we'll be in touch, I'm sure, with a lot of you over the next week or so. And here below is my contact information as well as Scott's. And certainly, we'll be sending out a replay and a profile here probably in the morning. And any questions, feel free to reach out.
And just a heads up, the numbers on there are incorrect. So disregard those. We'll be sending out an email. Those are not the right phone numbers. I don't know how those got on there. I
Oh, is that
apologize.
the look at that. Okay.
Yeah,
Well,
sorry about that.
yep.
Those are the correct emails. But I will we'll send out an email to you guys with a practice profile with our correct contact information. And just to back up on what Joe was just saying too, we are the buyers that we have in our program are vetted. Most of them are at least 100 million plus in assets, and have at least acquired at least one book before. So I think those are characteristics that you should be looking for in a seller. And we're more than happy to help you guys connect with people, whether and even if you just have questions, just feel free to reach out to you. And I appreciate you guys.
Yep, absolutely. And well, whether they've acquired or I mean, so we have some advisors who have never done an acquisition, and that's fine too. We actually like being able to help them through that process, but a lot of them do. I mean, people who are out there aggressively looking, they've done it before. That's why they're aggressively looking. But you could go either way. So appreciate the time, and thank you everybody. Have a great day and enjoy your weekend.